a SEBI registered advisory and PMS firm. So, as a background, Prabhakar is an engineering graduate. He did his B in CS and has some software and product manager experience prior to starting this venture. From last 8 years, he has been associated with Samviti Capital, and he is the co-founder and director. So, as we see today's topic, catalyst of price performance. So there are various patterns and tendencies which we will be discussing with Prabhakar. So Prabhakar, if I missed on to something in your introduction, I would request you to also add to it, and also how it started for you. Over to you.
Yeah, thanks, Prince. Yeah, I think before we start, the disclaimer, has to be said. So, everything that we discuss, on this call, please treat it as a educational, stuff. Do not act on, any stock or any idea without consulting your financial advisors, right? So that out of the way, so Prince introduced me. I'll just take 5 to 8 minutes to give you a quick background about how I got around to researching price performance. So basically, like Prince said, I am one of the co-founders of Samviti, and we basically manage money through two vehicles, PMS and a Category 3 AIF. Samviti has been 8 years old, but I've been, into the market since a very young age. So I've probably been in the market for about 20 odd years now. I started when I was just 16, and at that point in time I knew nothing about the market. What really attracted me to the markets was that I realized very early that this is a single player game, and your success and failure is completely in your hands, and there are no limits to your success if you are really good at this game. So it's an out and out meritocracy. Whether you are good or not also is known in black and white, by your PNL at the end of the year. So that is what really attracted me to the markets, and right from a young age I started following markets, and learning from a lot of my relatives as well as from books. So given my start from scratch, right, I experimented with almost all styles. I started with value. I graduated to growth. I tried momentum, special situations, you name it. So I've tried everything. But at some point, I felt that all of these were just strategies. So I really wanted to dig deeper and understand what really makes the prices move. Just because a stock is value, the price will not move. Just because a stock is cheap, it will not become expensive. And a lot of times we have seen a lot of expensive stocks will continue to make money for you. So I really wanted to understand, what is it that drives price performance. What is it drives or forces the market to give us those large price moves. So last several years I've dedicated myself to understanding what these catalysts are. And to give you a quick summary, and if I can just tell it in one line, the the most important catalyst that drives any price change, any large price change, if I have to put it in one line, that is the change in the perception of the future earnings of that stock. So let me repeat that. So what drives the price performance, or what drives the price of any stock, is when the market's perception of its future earnings changes. Now the question is, how will the perception of the futures and earnings change? It can change due to many other sub catalysts, right? So it could be by a recent earnings. So something that was earning 50 crores every quarter suddenly starts earning 75 or 100 crores. So that means the market's perception of the future earnings of that stock will change, because suddenly something different has happened. Similarly, other types of catalysts could be a management change, or it could be a government policy. So there are many such catalysts, a lot of which I covered in the thread, which is pinned on my profile, and which also Prince is shared here. So basically, every any stock you pick in the market where there has been a large price performance, you can go back and research, and figure out that there was one of these 7 8 9 major catalysts that led to that large price growth. So with that knowledge, armed with that knowledge, whenever you encounter, similar catalysts in the future, you'll be much better placed to, take advantage of them. So the most important of them, according to me, is the earnings surprise, because let's say the defense theme that is very, that's doing very well right now. So that is the catalyst for the defense theme, is basically a government policy. So there is a tailwind from the government, whereby the market believes that the government will push indigenization of defense, and the government will incentivize these companies, and a lot of orders will come. So nothing has really come yet, but the stocks have started moving in anticipation. But the real earnings print has not yet come. But there are several stocks in the market where the, for one reason or the other, the earnings also have started coming. So my focus really is on those categories, whereby the earnings are actually there on the paper. The turnaround has already happened, because these are the ones which are, much more high probability in nature and much more sure shot in nature. So every quarter you will get innumerable opportunities to play this setup. You can pick and choose the type of companies, whether large caps, mid caps, small caps. It will work everywhere. The only thing is, you have to get good at understanding what constitutes a surprise. And the surprise, like I said, can in the market should believe that the earnings will materially improve over the next few quarters. A quick example is what's happening to Ambuja, right? So what has happened? It was a boring old cement stock, right? Suddenly, the moment the market realized that Adani is going to take over, nothing has changed on the earnings side, but the stock has already moved up 50-60%, right? So it's basically the market's perception of its futures earning has changed. Now the market believes that somebody like Adani has the wherewithal to make it probably the largest cement player in the country. So it is these catalysts that you have to sort of identify, and become good at it. And once you do this for a few quarters, for a few years, then you will be in a very good position to identify the moves as they happen, understand what type of price performance can come out of each catalyst. And also you'll be able to explain any price move, you'll be able to explain any large price move, because believe it or not, every price move will have one of these catalysts in play. So that is how I would briefly introduce the setup and my background.
Right. Thanks, Prabhakar. So basically, you talked about various nuances which need to be considered for the price movement. So can we say over a period of time, when we spend time, we can master, that is one thing. But again, there are nuances when these things fail. So can you also want to discuss over that?
Sure. No, so like I said, it's, see, everything in market is a probability game, right? So instead of, like I said earlier, right? So a lot of times, if you're a value investor, right, you want to buy stocks which are cheap, right? But just if you speak to any experienced value investors, they will always tell you that for the value to be understood by the market, a catalyst has to come into play. So the failure will be your misunderstanding of the catalyst. The catalyst will always be there. It can never happen that without any catalyst, or without any change in perception about the future earnings of a given stock, a price move happens. So the catalyst will always be there. The mistakes will always be in our biases, to let us say, now let's take the example of Ambuja, right? So Adani has taken over. Now the market has built up a perception. Now you are working with this perception that Ambuja will, acquire, will become, grow in size. It will acquire other companies, and it will be very aggressive. It will have an advantage in logistics because of the Adani backbone. So you've built a thesis. Now where can you go wrong? You can go wrong, if one or two or three of these things start going against you. So once you have these catalysts in mind, once you've understood your thesis, it is actually much easier for you to recognize your errors and get out of the stock when you see that it is not playing out. So that's precisely the point I made. Eventually, every catalyst has to translate into tangible earnings. So you can, the market will give, time to some of the well-known stocks. It'll give it 2 quarters, 3 quarters, 4 quarters. But if the market sees that the earnings are not coming through, and the market's change in perception was wrong, the market will be ruthless to correct it. But what this framework gives us is, it gives us a habit to build a thesis, to try to understand why the stock is going up, what are the different variables in play. And once you understand those variables, you have to track them. Are they getting translated into the earnings or not? And if they are not getting translated into the earnings, then you immediately know that you've got it wrong and you have to take course correction.
Right. You talked about identifying the sectors, just like we discussed the defense thing. But there are times like if we talk about the semiconductor thing, at times the things are very far away, even the setup and the earnings, as you say. But again, those are the buzzword of the market. So how to segregate like which sectors we should follow and which should be avoided? How you go about it?
Yeah, so I'll give you an example. So this is one of the points I made earlier, that we have to. There are many type of catalysts in play, but we have to focus on the catalysts where the earnings are already there. So to give you an example, let us not get into the defense theme, right? Let's go into the capex theme, right? So the capital goods theme. Now, if you look at the earnings of the right from the bearing companies, or the the ABBs of the world, or the Siemens, or Schaeffler, you can see that the change is already reflecting in the quarterly numbers. If you look at the paper companies, right, the paper companies did extremely well. Now, this is not a story, it's actually happening, the numbers are coming. And so the change in the paper's fortunes was evident 2 3 quarters back. So if you just followed the quarterly earnings, so you don't have to go for the hope ones, the pie in the sky ones, right? So don't go for semiconductor, don't go for defense, because it's an if and but, whether if the current government is there for 5 years, 10 years, it all depends on a lot of things, so don't go for that. So there are enough and more ideas where the earnings are already coming. So my advice to, especially to the budding and the amateur investors or the new investors, is look at the sectors where the earnings are coming. So like I said, I named the sectors, right? So paper and capex, and these are the companies where the earnings is already on the paper, which is why the market is re-rating them the way it has in the last 6 months.
Right. And you also talked about like large opportunities, good execution, and good management will always be overvalued. So how, like you said, we should ignore PE and other things and we should accumulate whenever we get some sensible corrections or so. So would you like to touch upon this?
Yeah, so see, this is more anecdotal, right? So this has been, like I said, I have been watching stocks for, there are much more experienced people than me in the business. And, I may be wrong, but I have been watching stocks for the last several years. And what I have seen is some very few companies, right? So I will not apply this to all the companies. There are very, maybe 50, 60 companies in the country where the target opportunity size is so large, and if the management is good, and they have the capability, so that they have years of earnings growth ahead of them. So something like a DMart or something like an Asian Paints, these are names which will always look expensive. In the Indian market, you cannot expect to get Asian Paints at 15p and 20p, because it's a rare company. It is a company which can grow its earnings for many many years. But having said that, these kind of companies are more suitable for those who want to compound their earnings or compound their money at maybe 15 16% CAGR. So you cannot make a 40% CAGR in an Asian Paints on a DMart. But if you want to sleep well, if you want safety, you don't have time, then I don't expect you to go into paper stocks and defense stocks. But whenever there is a large correction, you go back and study the history, whatever history we have. Whenever there is a large correction, this 50p stocks or 60p stocks will come to 35p or 40p. At that point in time, most of us will wait for it to come to 20p, but that never happens. So whenever you see a large corrections in these handful of names which have proven themselves across cycles, and your return expectation is 12 to 15% or 15 to 18% at the max, you can go ahead and buy these companies, because they have proven that they will find newer and newer ways to increase their earnings, right? So Asian Paints is getting into five different things, right? Something like Astral, which has been perennially expensive, is now getting into two different things. So they have an ability to sort of increase, so what is called as optionality. Now these managements are so good. I was reading today about Titan, right? So Carrot Lane they acquired for some 350 odd crores, and now it is worth 7 8,000 crores. So these managements are very smart, so you can piggyback on them. But the what the high PE ratio means is that you cannot make 40 50% CAGRs. You have to, so if you are getting into them, you have to be happy with a 15% CAGR. But there is money to be made if for a very new investor who doesn't know anything, just by going into these handful of quality stocks.
So, Prabhakar, there is one point like breakout post a genuine earning surprise, popularly called PEAD.
Yes.
So, so basically, see, when we come to earnings, like for 1 2 quarters, for especially those who are into market, they are aware of the financial shenanigans. But those who have not that much exposure or are new to the market, so finding segregating which is genuine earning and which is forged one, how we should go about. I mean, a retail investor, how should we progress in such cases?
No, my advice is if you're a retail investor and you've not spent enough time in the industry to know about the shenanigans of the managements, uh, you can still play earning surprises. You can still look at turnarounds, but the simplest thing you can do is to just focus on the sector leader, right? So you don't
Prabhakar, voice is
if
breaking.
there is a
Can you
capex.
please check on your network, please?
Is it fine now?
Yeah, better, better.
Yeah, so what I was saying was if you're new to the market and you don't know which managements are good, which managements are bad, the simplest thing that you can do is focus on the sector leaders, right? So in case of a capital goods, you focus on an ABB, right? You don't go for a second and third rung earning surprise, right? In bearings, you focus on a Schaeffler, you focus on a Timken. You don't go to a second or third rung. In paper, you go to a JK paper, right? You don't have to go down the curve. You might not make the most amount of money, but if you still want to play the earning surprise, and generally good earning surprises will be across the sector, right? If you take the example of capex or paper, right? You go to any paper company, they have all given blockbuster numbers. You go to any decent capex company, capital goods company, they've all given good numbers. All bearing companies, all good numbers. So you have this choice to pick and choose. And for new investors, my recommendation is just go with the sector leader, and generally you will not go wrong if you go with the leader.
Hello. Hello.
Yeah, I'm there.
Yeah, better now. You can speak, Prabhakar.
Yeah, no. I was just saying that to the question that you asked, we can just go with the sector leader. In each of these sectors, if you don't know about the management and you see an earning surprise, you just go to the sector leader.
Right, right. So basically, when within a sector, almost all stocks, or maybe a considerable number of stocks are hitting all-time highs. So what pattern do we see there? There is a sector tailwind, or how we should see it?
Yeah. So see, when stocks are hitting all time highs, there is a small qualifier there, right? It has to be a new all time high. So whenever a stock sort of breaks out of maybe 3 4 year consolidation and hits a new high, so that is a convoluted way. The early investors who are fundamental investors will know maybe much before the stock hits the high, because they'll be tracking that company. They will know what changes are happening. But if you are a lay investor who doesn't have the time to really do the research, then you then the a new tracking new all time highs or new 52-week highs is a reasonably good a strategy to tell you where the action in the market is. And once you do that, your job is not done, because every day in a bull market, hundreds of stocks will hit 52-week highs. So number one, you have to find new 52-week highs, that is stocks which are hitting 52-week high after a long time. And number two, you have to start your research on what could be the catalyst for this. Is earnings the catalyst? Is government policy the catalyst? Is some other tailwind that is the catalyst? Is commodity price the catalyst? So you have to then, just don't go and buy blindly any 52-week high. 52-week high is just a quick way for you to, understand, what type of stocks are, wanting to go up. And then you go and do your research, identify the catalyst, and build your thesis.
Right. So basically, one very interesting point you mentioned in your thread, new IPOs breaking out to all-time highs a month or so after the listing. I mean, hello.
Yeah, yeah, I'm there.
Yeah. So basically, IPOs, I didn't get this point thoroughly. So if you would like to explain to our viewers, I mean, what?
Yeah, sure, sure. So again, this is purely on observation. So generally, I think personally, I think the factors are technical in nature, right? What happens is in an IPO, there are not, see, the number of investors who have got allotted the IPO are not many, right? Especially the good IPOs. What happens is, if 1,000 people apply, one person will get it. So generally, an IPO by definition is under owned. It is owned by a few institutions who have got some anchor, this thing. Uh, it is owned by promoters who will not sell. Institutions also don't sell. There are only a few retail investors who, own the stock, and all of them generally are not in a big loss, because there is no overhead supply. The technical term for that is overhead supply. So there is no overhead supply, and there is incremental demand because very few people own that stock. So whenever such a stock breaks out to 52-week high, or it breaks out its IPO, the first day high, that is a trigger that, if this stock starts moving, then it can really move very fast, because one, there is no overhead supply, and the existing guys will not sell because all of them are in profit, and there are enough and more new investors who want a piece of that action. So mutual funds, other retail investors, HNIs. So it takes some time for the stock to really, get distributed and get owned. And that process of discovery, sometimes if the float is less, then stocks can make very wild moves post IPO.
Right, Prabhakar. So, Prabhakar, if we ask you about position sizing, or say if you identify a good opportunity, so how you go about buying you buy in tranches, or you prefer, I mean, certain percent lump sum way, or what way you do it?
No, I generally don't believe in the, not so much in the tranche business, because uh, if something, especially for the, if there's an earnings surprise and a turnaround, then stocks can very quickly go up, quickly make a 30 to 50% move. So from a position sizing point of view, I started out my journey as a very very concentrated investor. Some of the people who know me from 2000, 7, 8, 9 will know that I was famously owning just one or two stocks in the portfolio. Many of the times I just own one stock. But as I have grown wiser, at that point in time the capital size also was small, but as I've grown wiser, I've understood the importance of diversification. So diversification is not just for mitigation of risk. Diversification also gives you a lot of optionality, because I have observed that many a times, if you have 10 stocks, and I ask you which stock will do the best, the stock which you expect to do the worst actually will turn out and do the best, right? Because that's how the market works, right? So in that sense, diversification, a fair diversification, is important, because sometimes you will own something in your stock which you just like a little bit, but you feel it's okay, it's a decent bet, let me take it, and that stock turns out to be one of the best performing stocks. So that you open up gates of serendipity by being diversified. But having said that, I don't believe in diversifying too much. For me, diversification is 20 25 stocks at the max. A very large portfolio can go to 35 40 stocks, but beyond that, I think you're better off indexing your money.
Right. So, what is the sell strategy then? So how you means if you identify a winner, so it should be like there are many approaches. Those at times we think the valuation has gone crazy and we book early in such cases, and at times we ride it with trailing stop loss or so. So how's your sell strategy?
Yeah, so sales strategy generally has two parts. One is if, like you said, if the stock is going crazy, if the valuation is going crazy, then you definitely have to so let's say you started with a 4% allocation, and that 4% allocation has become an 8% allocation because the stock has doubled, right? Then you have to, and you feel that this is an industry which it's a cyclical industry, or it's a industry where the margins have peaked out, right? Then you have to sell into strength, right? You have to book. So an example, let me give you two examples of both, right? So let me say paper. Now paper is clearly a commodity industry, right? Now you cannot expect to hold on to the paper stock for the next 10 years. You know that the going is very good for paper stocks. The market has already realized that. It has been 3 or 4 quarters since they're giving good numbers, and all this is happening because of a shortage in Europe and other countries. Now the moment that shortage goes away, right, all of these stocks will come back to kind of where they started, or at least halfway back there. So with commodity, so if you are owning a paper stock based on some thesis that there's a shortage of paper, and that's true for all the commodities, right? So we have seen it in the past. You can study case histories of HEG and graphite. You can study Rain Industries. You can study a lot of these things. But if you understand going in that this is a commodity company, it's much easier to book profits. You have to sell into strength because you know that these margins cannot be sustained. It's a special environment because of which they're earning these margins. So these kind of companies, you have to go and keep bring your allocation down at every opportunity, and you should not regret it because you cannot time the top, right? So the understanding, the clarity of thought of what kind of company I own is very important. Similarly, if you own something like let us say an ABB, right? I would not cut it in a hurry because ABB, I am playing a capex theme, let us say capital goods theme. Now my thesis, let us say, is that the in India the capital goods cycle has just started, and this will go on at least for next 3 4 years, right? So with ABB, I will not get into the profit taking business so fast. So that's also, you have to differentiate because I feel that the earnings, I'm just giving you I'm giving you examples here, but uh, ABB, let's say, I feel that the earnings can still go up 3x, 4x, 5x over the next 3 to 4 years. So ABB, I'm not going to be in a hurry. JK Paper, I'm going to be very watchful, and I'm going to take my profits whenever I feel that there is a froth.
Right. So we also talked about media pessimism about a sector reaching highs as per news report, paper magazines, while the sector is forming consolidating bottom or bottoming out. So how shall we go about identifying that this sector is near its what we say consolidating or bottoming out, so as to start building positions? And also, if you identify a good sector and see some tailwinds down the line, so you go for a basket approach, or you go stock specific?
Yeah, to answer your first question, so the quickest way to identify if a sector is going through a bad phase, you can do it very simply, in using one parameter, and that parameter is margins. Every time an industry is going through a bad phase, the margins will really take a bad hit because while operating leverage helps you when the going is good, it hits you back. It hits you equally bad on the way down. So any industry or any company where you see that they were earning during a upcycle a margin of maybe 15 16%, and they are earning a margin of 3 to 4% now for the last several quarters, you can be reasonably sure that the stock has kind of it's bottoming, right? Things can of course get worse. So this is I cannot make a this is a general statement. So when you see that if the margins historically or the last few years were 10 15, and now it is 3 and 4, and it's just fluctuating there, then that is those are the areas where generally media pessimism will come. Nobody will want to talk about those sectors because they have not gone anywhere for the last 3 4 quarters, right? So that is where your opportunity will be, if you're a value investor, to go ahead and identify if there is a scope for a margin to improve. So either you can preempt the market, or you can wait for the earnings to come. And the moment you see, one quarter where the margin has jumped from 3 to 4 again to, let's say, 5 to 6, then you can, get some clue that something is changing here. And the pessimism that was there, it might likely change. So you can go ahead and take a bet there. What was your second question? Sorry.
Second question was like you go for basket approach or stock specific. I mean,
Generally, from if it's a theme, then generally a basket approach. Generally a basket approach with allocations. For the sector leader will generally be more, and less as you go down the sort of curve, right? Because allocation is, I always say that, making a double on a 1% allocation, right, is the same as making 10% on a 10% allocation. So if you own a small cap which doubles but your allocation is only 1%, and on the other hand you own HDFC Bank where your allocation is 10% and the stock just goes up by 10%, you made the same amount of absolute money. So allocation is very important, and you just can't theoretically allocating very high for the worst companies may look like a good this thing, but it will not allow you to sleep well. So yeah, to answer your question, is generally a basket approach, with the most allocation towards the larger sector leading company.
right. So, guys, the floor is open for questions to Prabhakar. Anyone can send in the request and we can take up your questions. In the meantime, Prabhakar, which two, three sectors you see lucrative down the line, and which sectors you think have will be in consolidation or maybe correct from here on the basis of growth in the valuation also?
Yeah, I think, like I said, I think the sectors like capex, capital goods, infrastructure, defense, like I said, is very shaky because the earnings are not there yet. It's more of a story. It's a hope. But yeah, sometimes if the government is really, and this government has been, they have sort of done what they said they will do, even if it is with a lag. So so it is capital goods, infra, defense, and to some extent I would say financials, because financials have gone through a bad last 2 3 years, right? Post COVID, they've had a lot of trouble, a lot of cleanup. Prices have not gone anywhere. They're kind of under-owned. These are the sectors I think can do reasonably well. I think IT has a long way to go. Technology, IT, because it's precisely the same reason what I told in the previous answer, right? That margins, they've had very good times post COVID. The margins expanded like anything. They had the best of the order flow. They had the best of the margins with people working from home. So the earnings that we saw in the technology companies, a few quarters back, we are unlikely to, see them beat those numbers and do much better than that. Over the next few quarters, of course, exceptions, company specific exceptions will be there, but I'm speaking broadly. So I feel technology will underperform. It will go into that media pessimism mode, like how it was, pre-COVID, right? Infosys, TCS were available at 15, 16p. So I think it will go into a sideways kind of a thing, because the earnings will either be around these levels, or there'll be some sort of a margin contraction.
Right. So, Prabhakar, at times we go wrong with our bets. You give to a say if you picked any stock, say, and you the things do not pan out the way you assumed it should go. So, how much time you give it to before realizing or cut down the losses or so? I mean,
Generally 2 quarters. Generally 2 quarters. You have to give a company at least a couple of quarters, because in one quarter there is sometimes a lot of noise. It could be some global factor or something happened. But I would say on an average 2 quarters. If the management is very good, you can probably give them 3 quarters, but I think that's the max. So generally it's 2 quarters. 2 quarters, if the earnings are not showing you, there is no sort of improvement in the earnings, or things are not panning out the way you expected it to be, I think you have to be out.
So, Prabhakar, would you like to talk about your mistakes in the market? Because initially, when we start and we gradually learn so many things, we do a lot of mistakes. So, any mistakes you want to discuss?
Yeah, mistakes. There are many mistakes I've made, and that's, I mean, so so that is what. So my my portfolio has been a portfolio of experiments. So I've run many experiments, and I'm wiser for it. Uh, but yeah, I mean the mistakes. I think the biggest mistake, I will not want to go stock specific, because I think is a lack of clarity. Clarity of thought. So whenever you're buying a stock, you have to have clarity of thought as to why you're buying it, right? If you have that clarity of thought, you will know when to get out, you will know when to add, you will know when to reduce, you will know everything. So my mistakes, most of the times occurred when I bought the stock, for one reason, right? Let's say I bought the stock because the earnings, there was an earnings surprise, right? And uh, and then what happened is, some other event happened, like let's say a COVID happened or something happened. And at that point in time, I go ahead and sell it because of some other reason, because the market is falling, you get scared and you sell the stock. So if you have clarity that, okay, I've bought this stock because this stock has an earnings tailwind, right? So you are not supposed to then sell it on a normal market correction. Now, COVID is an extreme example, but this happens to us a lot of times. So we have one thesis on a stock, but that thesis is valid only till we see the next 10, 15, 20% fall in the markets. The moment that comes, we get scared and we sell at exactly the worst point in time. So I think anything and everything that we are doing. So if you are a trader, then you should have that clarity of thought that I am a trader, and I have a stop loss. I will exit when this happens. But if you are buying based on fundamental factors and selling based on a trading factor, or you're buying a breakout, but then when the breakout fails, you are justifying it with fundamentals. So so that is where most people go wrong, and that is where I have also gone wrong in the past. So my biggest lesson has been to develop that clarity of thought, that why am I buying this stock. And number two, that that is where it comes to diversification, right? If you own too much of a stock, the market will not allow your thesis to play out, because the market will scare you, and that is the nature of the markets. So if you own a stock which is, it's not, it's mathematically counterintuitive, but I have experienced it in the market. If you own, let's say, 3% of a stock, versus if you own 15% of a stock, and let us say the stock goes from 100 to 500, right? And in the middle, right, it goes from 100 to 200, from 200 to 75, and from 75 to 300. When you own 15%, you are most likely getting out of the stock at the wrong time. But if you own less, you can end up actually making more money in the market, because if your allocation size is less, you will not get scared out, and you will actually end up holding the stock for the reason that you bought it. So I would say these are the two main areas where I've gone wrong in the past, and that is what I'm looking at correcting. Clarity of thought of why I'm buying it, and having an allocation which allows me to hold that stock for long enough for my catalyst to play out.
Right. So basically, you manage public money. So basically, when you have a conviction over something, making one thyself understand is one thing, but making the clients understand is not as easy. Having said that, so how you deal with that situation? Because market is we have different market cycles and phases of market. So in such, you must be, or maybe at times people observe turbulence with the clients. So how you manage that?
No, Prince. So that's what. So look, see, I'm sure most of you would not even have heard of Samviti Capital, right? So, and that's by design. That's by design, because we are very, very careful, whom we onboard as customers. We onboard only people who have seen market cycles, and who have been around. And in fact, in our sales pitch, rather than selling them the product, we focus more on telling them all the downsides of the market, that how volatile the ride is going to be. Please don't come to us if you have, if you're bringing any short term money. Please don't come to us if you have any liquidity need for the next 3 to 5 years. So which is why we've probably, by design, not gone out and marketed and done all of that. And that has really helped us in a time like COVID, right? I will tell you, we hardly had any redemptions, we hardly had any customers who got scared out, and that was a big advantage for us, because so when you talk about managing public money, it's a completely different ball game. And you have to get the right kind of people. Of course, you can't get 100% of the customers to be perfectly aligned with you. There will always be, but that's natural. But at any point in time, if 20-30% of your customers are leaving you, and so then there's something wrong. So I think when managing public money, selection of client and the client trusting you is much more important, than any of your strategy. Because if the client doesn't trust you, like you said, they will bail out at exactly the wrong moment. So I think client selection is more important than strategy selection when it comes to managing public money.
Rightly said. So, Amit, you can unmute and ask your question.
Good evening, sir.
Good evening, Amit.
Sir, I have one question that from the last 1 year, I'm doing some investment. Like it's an index fund. So I'm investing only in index fund. So whether it is the right approach, whether I should go stock specific or I should be focusing on the index only. Because somehow when I take some stock, then I have seen that when it goes down, then sometimes it's very difficult to judge whether it will go up or not for a long term. But index, I'm sure that it will go. But the kind of return the index will give, that will be very less, I guess. So how to change my approach from the index to stock selection? Any ways there?
Yeah, no, Amit. I think of course, I have to commend you that you have, like I said, you have that knowledge that you are not an expert, and you have taken the absolutely right step in starting with index funds, which has ensured that you have not lost any money. You might not have made more money, but actually going by the last few 3 4 5 years, right? Index and the Nifty at least has been an out and out outperformer. It has been very difficult for funds to beat Nifty. So only in hindsight can you pick up funds which have beaten Nifty, and even if that is there, it's by not a very great margin. So I think going with Nifty is index funds is not such a bad idea. But having said that, like you said, yes, there is an opportunity and a potential to make more money in single stocks, in direct stocks, and that needs time, and that needs interest, and that needs attention. So if you are working somewhere else, and if you think that it can be done as a part-time thing, then I would advise you to not do it at least right away. So I would say the start with a small amount. Start with maybe 10% of your portfolio, and measure your performance. I think most of the people don't measure their performance. So if I ask anybody, the thing with for us PMSs and AIFs is that our everyday performance, every quarter, every month performance is measured, and it's in front of us. But individual investors hardly ever measure their performance. So if you really want to know, whether you should take the plunge or not, just take a data driven approach. Take 10% of your money out of the index funds, and start investing on your own, and then measure yourself. If you're beating the benchmark over a 2 3 year period, then by all means you can increase that from 10 to 30 40, and progressively take it higher. But don't do it on a on a whim or or a hope. Start small, prove it to yourself, and then take the plunge.
Okay, thank you, sir. Thank you, sir.
Thanks, Amit.
Vajpayee ji, you can unmute and go next.
Hello.
Okay, Varun, you can ask. Yeah.
Okay. Thank you for the opportunity. So you had spoken about your portfolio strategy of position sizing. So do you also have a strategy to size your allocation or exposure towards a particular sector, or that is not an issue for you?
No, so Varun, so the way we are set up is that see, as a PMS, as an AIF, you have to try to beat the benchmark, right? And to beat the benchmark, you have to actually overweight yourself sectors which are which are fundamentally and technically doing well. So in our case, clearly we don't have any sectoral, compulsions that I have to be in all the sectors. So right now, for example, I am not there in any technology, any technology stock, right? So just because, but Nifty has a very large weightage to, Infosys and TCS and these kind of names. So the way to outperform for people like us is to take a slightly overweight approach on a few sectors where you have conviction. So any sectoral caps actually don't make sense for us.
Okay, sir. So my second question is, I would like to know your view on pharma API and chemical specialty chemical companies.
Okay. No, Varun. So, specialty chemical itself is a very abused word, right? So, nowadays, a lot of companies are calling themselves specialty chemical companies, and one needs an industry expert to really, go ahead and, call themselves a specialty chemical. So, in pharma, to give you an example, something like a disease, is kind of a gold standard, in the API space, but the same cannot be said of granules. I'm just giving you examples. So I would take very company specific approach here, and not take a basket approach on specialty, the so called specialty chemicals, because specialty chemicals, some of them, the margins will fluctuate very wildly, and the price will fall much before the result comes, because the price is dependent on some commodity which is trading somewhere in Europe or some Russia or somewhere else. So you will have no control over what happens to the stock. So I would suggest to take a very stock specific approach, and really understand which of them are speciality, really in nature, in the sense that they can hold on to their margins, and only then go ahead and invest in them.
All right. Kishore, you can unmute and ask your question.
Thank you. Thanks for that. So, Prabhakar, I have one question. So, you mentioned about taking out some money from ETFs and try to measure your own performance, and then gradually uh, allocate more funds which you can invest on your own. Yeah.
Yes.
Uh, my main query here is, when we are benchmarking our performance against various indices, uh, the way in which even you are doing or the various funds do, isn't it more of a momentum investing, or trying to find out what will be in momentum next? Whereas as an individual investor, many might be satisfied with selecting two or three sectors and within them having conviction in few stocks where they invest gradually or they wait for price corrections to invest, and where they are not under any force from any other external investors, no kind of pressure on them, and they just hold on to it. So maybe month on month, quarter on quarter, they might be lagging, they might be having, they might be underperforming a lot, but maybe like 3 years, 5 years down the line, they will beat the index, or they'll be meeting their objectives. So how does one balance this out, right?
Yeah, Kishore, I mean, that's a good question. That's a great question, actually. See, we as public fund, fund managers, very, very honestly, I'm speaking here, we don't have that liberty. We don't have that liberty to, in the sense that at the portfolio level, at the stock level, you can still own a few stocks where you wait for your thesis to play out, and it might take 3 to 5 years. But at the portfolio level, if you are underperforming for 3 to 5 years, then the investors will, lose their patience, right? But you as an individual investor have that advantage, where you have the conviction, and where you are sure that within this sector I have an expertise, and whenever the sector there is a correction, I know that I can take advantage of it. Then by all means you should do that. You should not try to become a momentum investor, because then you will see, you have to do what you're comfortable in your skin. If you try to be a momentum investor, then momentum in the sense that doing, getting into things which are doing well. So I try to figure out what's going to do well in this cycle. So I'm trying to play cycles. So the cycles could be 6 months long, or 2 years long, or 3 years long. that depends on different situations. But some investors, like I said, earlier, Asian Paint and these kind of names, you just had to own them and do nothing, and you would have outperformed 80% of the professionals, right? But it needs a different mindset, it needs a different patience, so if you have it and if you want to do it and you're already doing well in that strategy, then there is no reason for you to look anywhere else. So end
Okay.
of the day, you should do what you're comfortable with, because only then will you be able to make money, right? So I
Yeah.
think it was Ed Sekota who said that, right? The market gives everybody what they want. So the momentum guys will make money off momentum, and the quiet guys who want to make money off value or some other strategy, they will make money through that. So sabka time aayega. So it's just a matter of waiting it out and having that patience.
Thank you. Thank you. Yeah.
Thanks, Kishore.
Yeah.
So, Prabhakar, how one should read the change in management, because it's always not positive or it's always not negative. So, how to read this?
No, Prince, I have a very, so again, so I am data driven, right? So I want to see the numbers. So I will, numbers and obviously track record, right? So if there's a management with a track record, you can preempt the numbers to some extent. And like I said, you can give it 1 or 2, 1, 2, 3 quarters, right? But if it's a management which is new, then I want to see the numbers. I will not go on a hearsay that, like delivery for example, I've heard very good things about the management, the very professionals, some of the best engineers, best technology, best managers, but I want to see the numbers. So a new company, I am okay to be late to the party, but I want to see delivery in terms of outstanding performance. uh, but for the older ones, like CG Power, Murugappa is a very famous example now, right? So Murugappas are like the next Tatas now, right? So we've had a big run in the Tata companies, and now the Murugappa companies are doing well. Now, these are guys who have been there for multiple cycles, right? And you have to respect them for that. So when Murugappas took over CG Power, right, the stock re-rated, like anything, it just went from $8-9 to 70-80 bucks in no time. And that is what, so the market clearly differentiates between people who have a track record and people who are new. And I think we as investors should do the same, right? So if there is somebody well known, you can back them, give them a few quarters to. And CG Power did that. CG Power cleaned up and showed the numbers, right? The same, but for a new management, I want to see the numbers. So I think that's the answer, right? So track with the guys with the track record, you can give them some leeway. New guys, don't give any leeway. Wait for the numbers.
Right, right. So, Prabhakar, these days we are hearing a word many a times. India is decoupled from the global markets. So, what's your view on this? Are we really decoupled, or it's just like we are resilient in these tough times? So, how you evaluate this?
See, I don't think there is any decoupling happening, because all said and done, see, every day we are getting FII flows, right? So how can we say we are decoupled, right? So FII flows are there, they're impacting our markets. So what is really happening, according to me, and I am no expert on macros and any of this, right? What is happening is basically, it's more of a technical factor. It's more of a technical factor. What happened is FIIs have sold down India to a large extent. They went underweight last year. They sold like anything. And domestic money, I don't know, you call it what, but for some reason, our markets did not fall in spite of the kind of selling FIIs did. And now, I spoke to a few, guys, a few hedge funds and all of that. And the view is that everybody is left out now. Everybody was underweight India, and India has been one of the best performing emerging markets. So everybody is getting pressure from the clients that you guys are not allocated enough. And that is why my sense is that, you see the kind of outperformance that you're seeing, right? Whether S&P is down 20% and we are flat, right? And so a lot of these, and the second thing is the tailwind from the currency, appreciation, right? So if the dollar has topped out, you know because see, the dollar is only outperforming against the euro. Most of us are following the dollar index. But what we have to understand is the dollar index is extremely heavily weighted towards the euro. So, just because the dollar index is breaking out doesn't mean anything. Actually, Indian currency has been very resilient. We have not broken 80. It may be RBI or it may be whatever. We have not broken 80. But if the dollar index starts coming back from 110 levels to back to 90 levels where it was, that will be another big tailwind, and the FIS cannot afford to lose both by being outside and also lose on the currency side, right? So I think it's more of a FOMO happening. FII allocations are very low. I think once that gets corrected, I think we will again come into some sort of a neutral territory. And so I don't think there is any decoupling happening. It's more of an adjustment, at the macro level. And you'll be surprised actually. We are only talking about India, but just look at the Indonesian market. The Indonesian market has outperformed India, I think, in the last 3 months. So the money is going to emerging markets, and some of the emerging markets are doing much better, because the global growth is in the is down in the drain. So there are few countries like India, Indonesia, and some of these other countries which are growing, and the stock markets are recognizing that, and these people are underweight. So that underweight to equal weight or overweight allocation changes are what is happening. That is my reading of this.
Right, right, right. You said. So, Prabhakar, you have any view on textile sector? You see any triggers going forward?
Specifically on textiles, no, nothing specifically on textiles. But I think they've all had a good run. They've all had a good run. We have to see, whether in any incremental sort of numbers come out. So I would wait and watch. See, all of these textiles and paper and all of these, we have to be doubly careful, because we cannot forget that these are commodity sectors. So we cannot get carried away, by these sectors. So these are not. I would never recommend anybody, to be a big buy and hold. Specific companies might be there which have done well, like a KPR, in textile sector. But as a sector, they are not, buy and hold for a long time kind of bets. So one has to be really sharp on their feet when you are investing in these kind of sectors, and don't try to sort of bottom fish, and don't try to only when there is a up cycle you can play them, and for that you have to be smart. You have to have experience in the market. You have to know when to enter, when to get out. So don't treat, one of the biggest mistakes investors make is they treat all sectors and all stocks alike from a strategy point of view. Your strategy for managing your Asian Paints position has to be very different from your strategy of managing Gokaldas exports, right? Because you have to understand that Gokaldas exports it's a commodity, right? It is not, you cannot. So you have to be always very very up to date, and either from a price point of view or the company fundamentals point of view, to understand what are the triggers. Because if you make a mistake in, you can't really make a big mistake in an Asian Paints, right? Because it is a secular growth kind of a company. The mistake you can make is, you might make no money for the next 3 years because you bought it because it's very overvalued, but you will not lose 70-80% of your money. But in a small textile company, if you've got the thesis wrong, got the cycle wrong, then you can lose 50, 60, 70% of your money. So you have to be able to differentiate that, what is the type of stock I'm owning, and then tinker your strategy accordingly.
Great, great. So, Prabhakar, how much technicals play a role in your buy-sell decisions at your Samviti Capital?
Technicals play a reasonable role, but it is, without an understanding of the catalyst, technicals have no meaning, right? So technicals either tell us that something interesting is happening, or they tell us, technicals play a bigger role in the selling actually, more than the buying. Because for buying you have other catalysts, other things in play. But in case of selling, you have to probably be cognizant of the technicals, because by the time a bad earnings comes, the price would have already corrected. So in that sense, having some sort of technical, and when I say technical, I don't mean these indicators like RSI and MACD, and all of that. When I say technical, I mean price action, in the sense that price and volume action. If if you see, on the charts, you can figure out, if a distribution is happening. You can't be 100% correct with these things, but it comes with experience. So if you feel that distribution is happening, then maybe you have to cut down your position. But purely on technicals, you cannot build a portfolio unless you are a trader who has technical buy and sell rules. Because I'll tell you why. Because if you go purely by technicals, then in any given day you will get hundreds and thousands of candidates which will qualify your criteria. So you have to have a second layer, or rather a base layer, to figure out, to cut down your universe and say that, okay, I'm going to look at technicals only if these XYZ factors satisfy, right? Because you cannot completely avoid technicals, because we are not supreme, right? We all the great investors you speak to, they always say that the market is always right. And what that means is you have to respect price. You cannot say that, I know everything about this company and the market is wrong. And that kind of an attitude generally over a period of time, over 10-20 years, will take you down. So in that sense, technicals do have a role to play. You have to respect the price. But like I said, you have to know the difference between like I said, if I buy something because the earnings are very good, right? And a general market correction happens, and the stock comes below, let's say, 200 EMA, right? Or a 50 EMA, then it's a general market correction, everything is falling, so I don't have to be so bothered. But if the entire market is doing well and only my stock is not performing, or it falls, then that technical signal has much more value. So these are the kind of small differences. To answer your question, I would say 20-30% is technicals, and the remaining is mostly earnings or other such catalysts.
Great, great, right. So, Prabhakar, our audiences would love to hear from you. I mean, who all can benefit from Samviti Capital? So, if you would like to talk on that front also.
No, like I said, Prince, no. So nothing. No sales pitch. So I
Okay,
am,
okay, that's
I am doing this
fair
more
enough.
from
Yeah,
an, educational point of view.
yeah, got. So,
I
so
any
right,
Yeah.
right, right. So, Prabhakar would like to know your view on behavioral finance, because we see the behavior is one thing which struggle in some way or the other, and we all have many vices with us. So, how we should control, and any good books you would like to suggest to our audiences?
No, I have a slightly different view, Prince, here. The behavioral finance and all is there, but I would give maximum weightage, like I said earlier, to to having some sort of a clarity of thought. You everybody should know what is their setup. If you know what is your setup, and if you can build a process to follow that setup, then you don't need any behavioral finance, right? So it is, the problems come when we are lost, when we buy something because somebody told us, or we buy something without really knowing why I bought it, or and I don't have any process to define, how much will I buy, when will I sell. So so behavioral finance and all you can read, but I think what is more important is to develop setup clarity. So are you a value investor? So what are your criterias? So how do you define value? So if you find a stock, how will you allocate, right? What is your criteria to get out? So that clarity has to be there in your mind. And number two, you should have a well defined process to identify such stocks and to execute your setup. So these are the two things that you should know. And I think these two things will trump any behavioral finance book. I have read all the behavioral finance books. So I've read everything, and I now believe that it's more to do with that clarity of thought, that you should know what you are doing, and you should have a process to execute it. If you have these two things, then behavioral finance is taken care of.
Right, great, great. So, Vajpayee, if you are there, you can unmute and ask your question. And I see many familiar faces: Prashant, Srinidhi, Shashank, Anish, Simrat, Deepak. So, if you guys have any questions from Prabhakar, you can send in your request. I'll approve. And in case due to some Twitter glitches, I'm unable to take your request. Sincere apologies for that. You can write your questions in the comments. Yeah, Shashank is there. Hey, hi Shashank. Shashank, you can unmute and ask your question.
Yeah, thanks, Prince. Prabhakar, nice hearing you and your thoughts. I had one quick question regarding, one point you mentioned that you need to allocate a certain amount to a particular stock so that you do not end up selling it before it has completed its entire run. So, but i- like, don't you think this is a kind of a heuristic or a bias here? That we are not allocating like much to a stock just because we might end up selling it.
Yeah, thanks, Shashank. Yeah, see, no, I'm not sure what it is, but that has been my practical experience, and also I've seen many other investors. See, the moment you own something, which is a large position for your portfolio, what happens is situations which are out of your control lead to a sharp cut in those stocks. So it's not that it's impossible to hold on to them, but yeah, you are right. It is a bias. It is a bias, and it is a bias that is prevalent, in all of us. And I think there are very few exceptional people who are fortunate enough to be able to hold on to very large positions, even if there are 30-40% cuts, right? If you see any large winning stock, whether it was the Amazon in the US or even here, right, Bajaj Finance and all of these names, they've all seen 30, 40, 50% cuts at least 3-4 times, right? So if you are allocated 10-15% of your portfolio and these stocks fall 50%, and one has the fortitude to sit through that, then that's exceptional, and there's nothing better than that. But but situations sometimes force you to do the wrong thing at exactly the wrong time, right? So they force you to sell when at the worst possible time, when you're supposed to be buying. So just to avoid that, I say that one has to have a moderation in the allocation process. So do not, if you can help it, well and good. But if you don't trust yourself, and so that's what I'm saying. So somebody who owned 3-4% of Bajaj Finance in the portfolio would have come out of COVID unscathed. But somebody who owned 20, 15, 20%, what would have happened is they would have because at that point you will hear the worst of the stories. You will hear the worst of the stories, and you will be forced to make that sell decision at the worst point. So yeah, if somebody can do it, nothing like it. But most people, I think 95% of the people, are better off allocating moderately and riding it than allocate heavily and go through the stress.
Right. So I mean, in your experience, what is it a particular percentage that you came down to? Like, I mean, we do all respect,
Yeah, I
Talib's.
think
Yeah, go ahead.
yes. So yeah. So I think there is no magic number, of course, but the research says 16, 17 stocks, but I think about 20, 25 stocks, so about 4% allocation is fair enough to give you a good upside, give you good diversification, and give you good optionality. So I think any number between 16 to 18 to 25,
Hmm.
I think, is a fair number.
Would you say that Stan Weinstein has written a wonderful book on different stages of a stock? Do you think it's a
Yes.
right strategy to identify a stage and manage allocations accordingly? Do you think? Because I personally, I mean, in my portfolio, I follow that. So, what I mean, any thoughts on that part?
No, absolutely. No, even in my portfolio, I end up doing that. So stage two is where I think Stan Winston, he says that is where the maximum money is
Correct.
made,
Yeah.
right? So stage two is what all the catalysts that I spoke about, right? They are there to identify the stage two. So essentially,
I see.
it's a good way to summarize it, right? So
Right.
we are looking for stage two, basically. Yes, absolutely.
Okay. Perfect. Yeah. Yeah. That's it. Thank you. Thanks from my side.
Thanks, Shashank. Thanks.
Vajpayee ji, you can unmute and ask your question. I think some issue. So, Prabhakar, anything we missed on discussing from the data points, the patterns which you have mentioned in your thread, or any concluding remarks from your side?
Yeah. Thanks everybody for listening. First of all, yeah. So all I would say is, just keep it's more of a, it's a pattern, right? So keep this mindset of trying to look for catalysts. Like I said, the catalysts can be divided into only a few subcategories, right? Earnings, management change, spin-off, and all-time high. So you can make your own list. I'm sure you can come up with more. But this habit of figuring out why is the stock moving up, or why will the stock move up, and then identifying one of the key catalysts, right? So generally, any stock making a big move, there will be not more than one or two variables that will be at play. It will never be 10 different things that is making the stock go up. It will be one or two things. If you can put your finger on it, you will be much better placed, in terms of all your decision making. So I would say, just next time you're buying a stock or looking at a stock, just figure out what the catalyst is. And once you start doing that and making it a habit, it will improve your investing process, by a whole lot. So that's all I would say, and thanks a lot for everybody for patiently listening.
Thank you so much for agreeing to our demand to host this educational spaces. It was really insightful learning new thing from you. And special thanks to Vivek Srivastava who wrote your name. To be honest, I was not aware about your handle, and I checked when Vivek mentioned it. So it was really great to have you today, and likely to invite you in future also. So, a very thanks from all the audiences who have been patiently listening to us from last one and more than 75 minutes. So, thank you so much, Prabhakar, and we'll keep in touch. And guys, those who are I mean, they can also check about his previous podcast available at IIC. I have pinned tweet that post at this spaces, and even at his handle you can check, and that's very different and insightful. So you guys can have a look. So thank you so much for coming, and thank you everyone. Thanks, Prabhakar.
Thanks, guys. Thanks a lot. Good night.
Good night.